Welcome. Welcome to the deep dive. Have you ever looked at something seemingly ordinary? Maybe just a blank sheet of paper or, a few numbers blinking on a screen and found yourself wondering how?
Wondering how it changes.
Yeah, how with just a few strokes of a pen or maybe a digital click, it could suddenly transform. How it could gain this profound monetary value, maybe even become money itself, or perhaps a powerful active tool for generating it.
It often feels like a touch of financial magic, doesn't it?
It really does. That sense of transforming something mundane into something so potent is, well, it's truly fascinating.
It is.
Well, today, we're embarking on a truly unique and I think quite an eye-opening deep dive. This one is specifically tailored for you, the dedicated staff at the Royal Bank of Trinidad and Tobago.
Right.
Our mission really is to pull back the curtain on your pension process. We're going to go far beyond simply understanding how it works on the surface. Instead, we want to explore the intricate underlying financial mechanics.
Right. Getting right into the gears, turning behind the scenes, beyond what's immediately visible.
Exactly. And crucially, we're going to shine a very bright light on who truly benefits the most from this intricate and honestly quite a fascinating process. It might surprise you.
That's right. For this deep dive, we've meticulously analyzed a range of sources. These include some truly in-depth studies of financial instruments themselves, examining their precise legal definitions, and their fundamental role in the creation of money within the broader financial system.
And then we've integrated specific discussions on how large pension funds, like the one you're part of at Royal Bank, operate within this very system. We're examining the sophisticated mechanisms that allow them to not just manage funds, but also to generate significant value and, yes, profit.
So prepare yourselves. This isn't just a basic overview. Think of it more as an investigative journey, really, an exploration into an incredibly intricate world.
Yeah.
A world where legal documents, collective trust, and central bank policies all intersect in ways you might never have considered.
All these elements coming together.
Indeed. All these elements come together to create value and move money, often, beneath the surface of what's immediately visible in your daily transactions.
So, to begin unraveling the mystery of how your pension fund and financial instruments in general acquire their power, we must establish foundational understanding. What are financial instruments actually, and how do they play a role in creating money?
Let's start at the very beginning.
Yeah, exactly. When we talk about a financial instrument at its most basic level, we're talking about a legal document. It represents a monetary contract between two or more parties.
So it's not just an abstract idea then, it's something concrete.
That's precisely it. It's something concrete, something enforceable by law. And that legal document aspect is absolutely foundational. It's the starting point.
Right.
For those who might be just starting out in banking or maybe newer to the intricate mechanics of finance, you could imagine, say, two friends. One promises to pay the other some money back next month. If they just shake hands, it's a promise, right? An oral agreement. But if they write it down, clearly stating the amount, the date, and both sign it, it's now a document.
A bit more formal.
Exactly. And if that document is created according to specific rules and legal formalities, it can transform into what we call a financial instrument.
Aha.
This means it carries legal weight and can be recognized and used by the wider financial system, not just between those two friends. It gains power.
And that transformation is key. The fascinating thing is these instruments come in a surprisingly wide array of forms, each designed to serve a distinct purpose within this vast financial landscape. We can categorize them broadly, sort of, to make sense of them.
Okay.
First, you have cash instruments. These are perhaps the most straightforward. Think of the physical currency in your wallet, the notes and coins, or money held as a deposit in your bank account.
Right. Tangible money.
Exactly. These are direct representations of value, immediately spendable.
Okay. That feels pretty direct and tangible. What about things that aren't so immediate? Things that depend on something else?
Right. Then there are derivative instruments. These are a bit more complex because their value is derived from an underlying asset.
Derived. Okay.
Yeah, think of options or futures contracts, for example. These are agreements whose value is linked to maybe a stock or a commodity like oil or even an interest rate.
So if the price of oil goes up, the value of the derivative linked to it changes.
Exactly. If the price of that underlying stock or commodity changes, the value of the derivative changes. Its value isn't intrinsic. It's dependent on something else shifting.
So their value isn't intrinsic. It's dependent on something else shifting, almost like a financial reflection of another asset. That definitely adds a layer of complexity.
It certainly does. We also deal extensively with debt instruments. These are essentially formal promises to pay a sum of money at a future date, usually with interest.
Okay, like an IOU.
A very common example is a promissory note. It's like an IOU, yes, but it's legally binding, clearly stating who owes what to whom and precisely when it needs to be paid.
Like the note you sign when you take out a mortgage from Royal Bank to buy your house. That's a massive promissory note, right? A promise to repay over many, many years.
A perfect example indeed. That's a huge debt instrument. Or government bonds, which are promises by a government to repay borrowed money, usually with interest, to whoever holds the bond.
Right. Buying a government bond is like lending the government money.
Exactly. Then we have equity instruments, which represent ownership.
Like shares.
Shares of stock in a company, precisely. So, if you own stock in Royal Bank, you're literally a part owner of the bank.
A tiny slice, but ownership nonetheless.
That's right, a fractional owner. And finally, there are more specialized commercial forms, things like trade acceptances and drafts. These are often used to facilitate trade credit between businesses.
Trade credit. So one business giving another time to pay?
Exactly. If one company sells goods to another, they might use a trade acceptance. The buyer formally agrees to pay a certain amount at a future date for the goods received. It's a structured, legally recognized way of giving and receiving credit in commercial transactions, much more formal than just an invoice.
Okay, so we have everything from simple cash to these very nuanced commercial arrangements. But what's the fundamental common thread that binds all these diverse forms together? What makes them all qualify as financial instruments? Is there like one core thing?
That's the crucial question. Despite their varied forms, they all share a core characteristic. Their underlying value proposition. See, these instruments don't just hold value because someone arbitrarily decided they should.
Okay.
They derive their value from a legal right.
A legal right. So something that the law explicitly recognizes and will indeed enforce. That sounds quite powerful.
Precisely. It's a legal right to either receive or deliver money, or goods, or even another financial instrument in the future. Think of that simple promissory note again.
The IOU.
Right. It isn't just a scribble on paper. It's a legally enforceable promise backed by the entire commercial and legal system. If John promises to pay Jane $1,000 and signs a proper promissory note, Jane doesn't just have a friend's promise. She holds a legal claim to that $1,000.
A claim the courts would uphold.
Absolutely. It's why institutions like the Federal Reserve, the U.S. Central Bank, specifically include notes, drafts, acceptances, and bills of exchange as eligible financial instruments. They are recognized as having standing.
That highlights their recognized standing and how deeply embedded they are in the entire financial system. And similar principles would absolutely apply to how the Central Bank of Trinidad and Tobago operates within its own financial ecosystem, right?
Oh, definitely. The exact regulatory details might differ slightly, of course, but the fundamental idea of these documents having profound legal and monetary weight is the same. It's universal in modern banking.
So it's not just a U.S. thing.
Not at all. The specific nuances of regulation might vary, but the underlying principle of recognizing these instruments as having both legal and monetary weight is universal in modern banking and central banking. This means that a properly structured and signed document can be treated as a valuable asset, not just by the two original parties, but by the wider banking system.
Enabling trade, lending, investment, all that stuff.
Exactly. On a grand scale.
Now, here's where it gets truly interesting and perhaps a bit mind-bending for many of us, especially if you're approaching finance from maybe a less technical background. We've seen how simple legal documents gain immense power.
Right. The legal backing is key.
But how does this power extend to something as vast as a national economy? This is where the truly mind-bending aspect comes in. How central banks, whether it's the Fed in the U.S. or your own Central Bank of Trinidad and Tobago, actually use these very instruments to, well, inject liquidity and create new money.
And to be clear, we're not talking about printing more physical notes here.
No, exactly. This is about something far more subtle and profound.
This is truly a powerful concept because it fundamentally challenges the traditional notion that money is only printed by a government mint. One of the primary ways central banks do this is through the discounting of instruments.
Discounting. Okay, what does that mean exactly?
Imagine a situation where a commercial bank, perhaps Royal Bank, holds a promissory note or a bill of exchange from one of its clients.
Okay, so a client borrowed money from Royal Bank, and they signed a note promising to pay it back later. That's a future promise of payment held by the bank.
Exactly. This instrument represents a promise of future payment to Royal Bank. Now, when a central bank discounts such an instrument for the commercial bank, it's not just buying it like you might buy a stock. What it's doing is providing the present value of that instrument to the commercial bank.
The value today, not the future value.
Right. And it provides it in the form of central bank credit. This central bank credit is, in essence, new money injected into the system.
Wow. Okay. So a future promise has literally turned into today's spendable money. That's a profound act of financial alchemy, isn't it?
It really is. From a piece of paper representing a future payment, immediate liquidity is created.
But for many listeners, that might sound almost too good to be true. Are there inherent risks to this alchemy? I mean, how does the central bank manage potential instability when it's basically turning future promises into present cash?
That's a critical question, and yes, there are risks. They're primarily managed through the central bank's very careful selection of eligible instruments. They don't just accept any old promise.
They only take the good stuff.
Pretty much. They accept only high-quality, low-risk collateral. And they apply a discount rate, which is essentially their interest charge for providing the money early. That rate acts as a buffer and influences borrowing costs. Plus, they monitor the overall money supply and inflation very, very closely.
Okay, so there are controls. Can you give a simple example of the numbers?
Sure. Let's say Royal Bank has a client's promissory note for $1,000 that matures in 90 days. But Royal Bank needs cash now. Central Bank might agree to discount it. They might give Royal Bank, say, $980 today for that $1,000 future promise.
And the $20 difference, that's the central bank's cut.
That's the discount, yes, or the interest the central bank earns for giving the money early. But what's crucial, the key part, is that the $980 advance to Royal Bank immediately increases that bank's reserves.
Which means they suddenly have more money available in their reserves. So they can lend more to other customers, maybe.
Precisely. Or they can use it to meet daily withdrawals if lots of people want cash. It allows them to lend more or meet their own liquidity needs. This process, at its heart, monetizes the instrument.
Turns it into money.
Exactly. It converts a future obligation into present, spendable, usable currency, effectively expanding the money supply without physically printing notes. It's an increase in the electronic money banks have available to use.
So the profound insight here, for someone working at the bank, is that your customer's future promise to repay a loan isn't just a record sitting in a file.
Not at all.
It's a direct input into the immediate, spendable money supply that Royal Bank has at its disposal. It contributes to the nation's liquidity.
That's pretty mind-boggling when you consider the sheer scale and reach of it all. This isn't just about managing existing money, it's about expanding its very existence based on promises of future value.
And central banks have other crucial mechanisms for injecting this liquidity too, right? It's not just discounting these notes.
That's right. Another critical mechanism is through discount window operations. Depository institutions like Royal Bank can pledge various qualifying financial instruments, think loan notes from customers, commercial paper from corporations, or other high-quality collateral through their central bank's discount window.
So they use these assets as security, much like you might use your house as security for a mortgage. Why is this so important for a commercial bank like Royal Bank? How does it help them directly in their day-to-day business?
Oh, it's vital. It's vital for their day-to-day operations and stability. Upon approval, the central bank advances credit to these institutions, usually at a specific interest rate called the discount rate.
And that directly increases the money available.
Yes, directly increases the money supply within the banking system. It allows commercial banks like Royal Bank to make more loans or just strengthen their balance sheets, especially if they face unexpected demands for cash or need to adjust their reserves quickly.
So it's like a safety valve or a quick source of funds.
Exactly. It's how the banking system gets quick, reliable access to funds when needed, ensuring stability and continuous lending, which is crucial for the economy.
And there's even a program that makes this process incredibly efficient for the banks, making it even easier to access these funds, as I understand it. Something about keeping the documents.
Indeed. In some jurisdictions, it's often referred to as the Borrower in Custody, or BIC, program. Under this program, institutions can actually hold the pledged loan instruments, those promissory notes from their clients, for instance, on their own premises.
Really? So they don't have to physically send the actual paper documents to the central bank? They can keep them right there in their vault or maybe on their digital system?
That's right. They retain physical or digital custody, but can still use them as collateral for borrowing at the central bank. This is a significant operational advantage for large banks.
I can imagine. Less paperwork, faster access.
Exactly. It accelerates their ability to convert these credit instruments into spendable money without the logistical hurdle of physically transferring vast amounts of paper back and forth.
So immediate access to funds against assets they still physically possess. That sounds incredibly convenient for liquidity management, especially for large financial institutions like Royal Bank.
It truly streamlines the process, allowing for faster responses to market conditions or unexpected demands for cash, which is crucial in a fast-paced financial world.
What's particularly profound about these practices, I think, is how deeply rooted they are in law and established financial principles. We're not talking about some obscure loophole here, right? This is how the system works.
Not at all. These are mechanisms directly upheld under very specific legislation and central banking mandates. Historically, in many nations, legislative actions, like those seen during the Great Depression in the U.S., effectively suspended the direct convertibility of currency to gold.
Right. They went off the gold standard.
Exactly. And this crucially granted central banks the authority to issue money solely based on credit instruments and, well, faith in the government and its financial system.
That was a fundamental, even global shift in how money is conceived and created. It means that financial instruments are far more than just records of debt or IOUs.
Much more.
They are legally sanctioned vehicles through which the central banking system creates, regulates, and manages the flow of currency in the economy. They are absolutely foundational to both public and private sector liquidity.
Which underpins everything. It truly does.
Precisely. It underpins all modern finance, including the operations of Royal Bank and the wider economy of Trinidad and Tobago. So think about it. The very paper you might be signing for a loan at the bank, or the digital record of a corporate debt held by the bank, it isn't just an agreement.
No.
It's a potential catalyst for money creation within the larger financial system, contributing to the overall supply of money that circulates.
That's pretty mind-boggling when you consider the sheer scale and reach of it all. It really changes how you see a simple loan document.
All right, so we've established that financial instruments are these powerful legal documents, and they can facilitate the creation of money. But let's pause for a moment and ponder a truly fundamental question, one that might seem a bit philosophical maybe.
Okay.
How does a blank piece of paper, with just some ink applied to it, suddenly become a financial instrument with real, tangible value? What truly gives it that immense power?
It's not magic, right? Though it sometimes feels that way.
It feels a bit like it, but no, it's not magic. The answer lies in a sophisticated confluence of factors: lawful authority, an enforceable obligation, deep-seated trust in the issuer, and crucially, its eligibility for acceptance within the commercial and banking system.
A whole combination of things.
Exactly. These elements aren't new. They're built on centuries of legal precedent, often codified in things like the Uniform Commercial Code, UCC, in the U.S., or similar commercial laws globally that ensure consistency and predictability in commercial transactions.
And this is where the foundational components come into play. First, you need offer and acceptance. This is the absolute bedrock of contract law. The instrument must clearly contain an unconditional promise, like a promise to pay, and clearly identify all the parties involved.
Who promises what to whom? For those new to banking, it's like when two people agree on a deal, I'll give you X if you do Y. That's the basic offer and acceptance. But for a financial instrument, it needs to be really precise. Why is that precision so critical?
That precision is critical because it removes ambiguity, making the promise legally undeniable. It must specify a certain sum of money and a clear date or condition for performance.
A wiggle room.
Exactly. For example, a signed promissory note for, say, $100,000 between John Doe and XYZ Bank with a stated 5% interest rate and a repayment date immediately sets up that legal framework. It defines the what and the when of the promise with absolute clarity, which is essential for legal enforceability later on.
So it's not enough to just scribble something down. It has to be a proper, legally structured agreement.
Okay.
It has to clearly articulate the terms of the deal for it to be recognizable by the system. And that leads directly to the second crucial component, the signature.
Ah, yes, the signature.
Whether it's old-fashioned wet ink on paper or secure electronic signature for digital documents, it serves as the unequivocal evidence of the signer's intent.
Their intent to be legally bound by the agreement, that signature isn't just a scribble, it's a solemn legal commitment. It says, I agree to this.
Precisely. It forms the very core of liability. As commercial law often states, a person is not typically liable on an instrument unless they have signed it. Without that signature, it's just paper. or an unverified digital file.
It lacks that crucial element of personal or corporate commitment, which naturally brings us to the actual exchange of value, what's being given or received.
Right. What's the why behind the promise? Why would someone sign such a document in the first place?
That's the third component,
Yeah.
consideration. There has to be a real, or at least a constructive, exchange of value for the instrument to be valid.
Value, like money changing hands.
Not always physical cash. It could be credit extended, like the bank giving you the loan money. It could be services rendered, or even simply the right to delay collecting an existing debt.
So it's about the give and take. You give a promise, maybe to pay later, and you get something tangible in return right now, whether it's cash or goods or services or even just time.
Exactly. It's a two-way street of value, making the agreement mutually beneficial and legally binding.
What about the people or entities involved in this transaction? Do they need specific qualifications or statuses? Can anyone just sign these things?
Good question. That brings us to legal capacity and enforceability. The person or entity creating the instrument, the maker, must have the legal capacity to do so.
Meaning they can't be coerced into signing, for instance? Or they can't be a minor who legally isn't allowed to enter into such significant contracts? Or mentally incapacitated?
Exactly. They can't be under duress, nor can they be legally incapacitated, like being a minor or not mentally sound. Furthermore, the instrument itself must be lawful.
Lawful purpose.
Yes, it cannot violate any statutes or go against public policy.
Yay.
An instrument created for an illegal purpose, say, to fund a crime, would hold no value in the eyes of the law, no matter how perfectly it was structured or how many signatures it had.
Okay, makes sense. So it needs to be made by someone capable for a legitimate purpose. And finally, to truly unleash its power, it needs to be recognized within the larger financial system, right? It can't just exist in a vacuum between two people in a backroom deal.
That's absolutely right. The fifth and arguably most critical component is monetary system recognition. This is where the instrument transcends a simple agreement between two parties and enters the broader financial ecosystem.
The big leagues.
You could say that. When it's accepted by a commercial bank, like Royal Bank, or recognized by a court for enforcement, or accepted by a central authority like the Federal Reserve or the Central Bank of Trinidad and Tobago, it transforms into a recognized asset.
So the system validates it. It's like a passport that gives it currency in the wider world. It allows it to move beyond its origin and be used by others.
Precisely. Central banks, for example, are authorized under law, like the Federal Reserve Act in the U.S., to accept certain bills of exchange and promissory notes as eligible collateral for lending. This acceptance by a foundational institution is what truly imbues it with monetary power.
Power to be bought, sold, used as collateral.
Exactly. Across the entire system. It's not just a promise anymore. It's a promise that the entire financial structure stands behind, in a way.
So what does this all mean for that seemingly blank piece of paper we started with? It means the core principle is this. Trust plus enforceability equals value.
Trust and enforceability.
Yeah. The paper becomes money-like, not because it's printed with a specific design, but because others in the system trust that the promise inscribed upon it will be honored. And crucially, because courts and legal systems will enforce that promise if it isn't.
Makes sense.
There's a powerful quote from a U.S. Senate report back in 1973 that perfectly encapsulates this. Money is not metal. It is trust inscribed.
That quote is profoundly accurate. It really speaks to the abstract yet incredibly powerful foundation of our entire financial system. It's the collective belief in the system.
The shared confidence.
Yes, the shared confidence and its ability to uphold agreements that gives these instruments their real-world power. It's what makes a piece of paper or just a digital entry hold value and circulate through the economy.
Let's truly drive this home with a real-world example, one you might even encounter indirectly in your work at Royal Bank. Imagine you're a new employee, perhaps just starting out, and you encounter a customer, John Doe, who has written a promissory note.
Okay.
It clearly states, I, John Doe, promise to pay Jane Smith $10,000 on December 31st, 2025. He signs and dates it. Jane accepts it. At first glance, it's just a piece of paper, right? A personal agreement between John and Jane.
For someone just starting in banking, it might just look like a very formal IOU, that's all.
But because it contains all those foundational components we just discussed, a clear offer and acceptance, John's binding signature, the consideration, maybe Jane lent John $10,000 today,
Yeah.
and John's legal capacity to make the promise, it immediately gains legal recognition.
So it's more than just an IOU.
Much more.
Right.
It becomes enforceable by law, governed by commercial contract and negotiable instrument law.
And this legal recognition is what gives it its unique power. Beyond just a simple promise between friends, it now carries the weight of the entire legal system behind it. If John doesn't pay, Jane can take legal action.
Exactly. Because it's legally recognized and enforceable, it becomes transferable.
Right.
Jane, the payee, the person owed the money, she can now sell this note to a third party before December 2025.
Sell it to someone else entirely, like a total stranger or a business, even a bank.
Yes, precisely. Maybe another individual, or even a bank like Royal Bank or an investment firm. Why would that bank or investor buy it?
Well, they'd trust John would pay eventually.
They trust it will be honored, yes. Partly because they trust John, maybe, but more importantly because they know the courts will enforce it if John doesn't pay up when the time comes. They are, in essence, buying a future legal claim to money.
Okay, they buy the right to collect the $10,000.
Now, here's the kicker, and this is where the money creation aspect comes full circle, connecting back to our earlier discussion. If Jane sells that $10,000 note to a bank for, say, $9,500 today, because the bank is buying it early and taking on the future risk and wants to make a profit, the bank has effectively created new money.
How? By giving Jane the $9,500.
Yes, by advancing that $9,500 to Jane in exchange for a future promise of $10,000. They've monetized a future obligation into present spendable funds for Jane.
That's fascinating. They created the $9,500 in the present for Jane. That money didn't exist in her account before. She can now go spend that money immediately, and it adds to the money supply circulating in the economy.
Precisely. The bank then holds the note and collects the full $10,000 from John later, making a profit on the difference, that $500 discount they applied. This demonstrates the bank's role as a creator of credit and liquidity.
So the value isn't inherent in the ink or the paper itself, nor is it physically created out of thin air like printing press money. It's in that robust, legal, contractual, and institutional framework.
That's what does the trick.
That's what transforms a personal obligation into a recognized, enforceable, and trust-backed asset. This is fundamental to how banks operate, creating credit and liquidity in the economy daily.
That's how a seemingly blank piece of paper, when imbued with intention, proper form, legal backing, and collective trust, becomes a powerful monetary vehicle. It's a sophisticated dance between law, trust, and practical application. And it underpins almost everything we consider money today, from your mortgage to international trade.
It's an incredible system when you break it down like that. It moves far beyond just the simple exchange of physical cash we usually think about.
So we've covered the fundamental idea of financial instruments as powerful legal documents. But the world of finance is incredibly diverse, and these instruments come in many forms, each with its own specific use. Our sources detail at least 10 distinct scenarios where various private and business transactions also create these powerful financial instruments, which can then be leveraged within the financial system.
Right, it's not just loans.
Exactly. We could list many, but let's highlight a few that might directly intersect with your work at Royal Bank, demonstrating just how diverse these instruments really are.
Absolutely. Think about it. You have the basic promissory note, maybe secured by real estate like we discussed with mortgages, but then there's a bill of exchange.
What's that used for mainly?
Often used by a business to order its bank to pay a supplier, perhaps in another country. It streamlines international payments. Or even a bank draft, issued by a bank at an account holder's instruction for a guaranteed payment.
So, more secure than a personal check.
Much more. Ensures certainty in large transactions. Then there's a trade acceptance, where a seller extends credit directly to a buyer, delaying payment. Crucial for business-to-business commerce.
And then you have more unique instruments like a warehouse receipt. I find this one interesting. It acts as a document of title to goods stored in a warehouse.
That's right. And it can actually serve as collateral for a loan. It's not just a piece of paper listing goods. It's proof of ownership of those tangible assets stored away.
Like proving you own the sugar or cocoa stored there, and you can borrow against it. Amazing.
Exactly. We also have negotiable certificates of deposit, or CDs. These are time deposits issued by banks that, unlike regular CDs you might have, can actually be bought and sold on secondary markets before they mature.
Offering investors more flexibility than just waiting for maturity.
Precisely. And letters of credit, where a bank guarantees payment on behalf of a client, are absolutely crucial in facilitating secure international trade transactions. They reduce risk massively when dealing with unknown buyers and sellers in different countries.
So a seller in, say, China knows they'll get paid by a buyer here in Trinidad because Royal Bank has guaranteed it with a letter of credit.
Exactly, significantly reducing risk for both parties. Even an assignment of accounts receivable.
What's that now? Sounds complex.
It's where a business sells its future incoming payments, like money owed by its customers from invoices, to a bank or financial institution for immediate cash. That assignment document itself is a financial instrument representing a claim on future revenue.
So they get cash now instead of waiting for customers to pay.
Right. Helps with cash flow. And finally, commercial paper, which is essentially unsecured, short-term debt issued by large corporations to meet immediate cash needs. It's actively traded among institutions.
What's truly remarkable is that each of these instruments, every single one, when lawfully created, properly signed, and legally enforceable, can function as a monetary asset.
Right. They aren't just passive records.
No, they are active components of the financial system, constantly in motion, being bought, sold, pledged.
That's the key point. They can be pledged as collateral for loans, discounted to generate immediate cash, sold outright to investors, or otherwise converted into present funds. This is critical. The financial system isn't just about physical currency or what we traditionally think of as money.
No, it's way bigger.
It's about this broader ecosystem of recognized financial claims that can be put to work, that can be monetized, supporting economic activity and liquidity throughout the entire economy.
And these instruments gain their full monetary and legal power only when they are accepted and embedded within a recognized statutory and institutional framework. It's this recognition by key players, banks, courts, central banks, that truly solidifies their value and role.
Without that recognition, they're just pieces of paper again.
Exactly. Let's look at how different institutions recognize and accept these diverse instruments. Who takes what?
Okay, so who accepts what? Well, first we have commercial banks, like Royal Bank itself. These are your private lending and deposit institutions, and they are constantly interacting with these instruments.
Every day.
Every single day. They regularly deal with promissory notes for things like mortgages, auto loans, personal loans. They recognize them as legally binding promises to repay funds they've advanced.
These notes are truly the bread and butter of banking, aren't they? They form the very basis for much of Royal Bank's lending activities and investment portfolios.
They absolutely do. Commercial banks process millions of checks daily as payment instruments, facilitating transactions. They also purchase or discount commercial paper as part of their investment activities or to manage their own short-term liquidity needs.
Managing their own cash flow.
Right. And certificates of deposit, or CDs, are issued by banks as negotiable time deposits that can be traded or pledged as collateral, providing both a savings avenue for customers and a stable funding source for the bank itself.
So commercial banks are constantly creating, trading, and relying on these documents for their daily operations. What about the courts? How do they view these instruments, and what's their role in giving them power?
The courts. They provide the judicial recognition that ensures enforceability. A promissory note, for instance, is routinely used in breach of contract lawsuits as direct evidence of debt.
Exhibit A.
Pretty much. It's enforceable by a judgment that can compel payment, seize assets if necessary.
So the courts back them up. If someone doesn't honor the promise on the paper, the courts can step in and make them. That gives these instruments some serious teeth.
Precisely. Bills of exchange and trade acceptances are recognized in commercial disputes, ensuring that trade transactions can be legally upheld and obligations enforced. Indemnity bonds and surety bonds are accepted by courts to guarantee performance or fiduciary duty in various legal contexts, like construction projects or handling estates.
Making sure people do what they promised legally.
Right. And critically, trust deeds and mortgage instruments are the legal foundations for enforcing property rights. They can lead to foreclosures or other equitable remedies if loan terms are not met. The courts are the ultimate enforcers, ensuring the promises they represent aren't just words on paper, but actionable legal claims.
Okay. So banks create and trade them, courts enforce them, and then there's the central bank, which plays a truly unique and powerful role in the larger financial plumbing of a country. What do they accept?
Absolutely. The central bank, whether it's the Federal Reserve, the Bank of England, or the Central Bank of Trinidad and Tobago, acts as the monetary authority and the ultimate liquidity provider. It accepts several key instruments to manage money supply and support the banking system.
Like what?
Eligible bills of exchange and promissory notes are accepted at the central bank's discount window as collateral. This allows commercial banks like Royal Bank to borrow directly from the central bank.
Giving them essential liquidity.
Yes, especially in times of stress or just to meet daily operational needs.
So if Royal Bank needs a quick injection of cash, perhaps to cover a large unexpected withdrawal, they can use some of these high-quality instruments they hold as security with the central bank, converting those future claims into immediate cash.
Exactly. Government securities like U.S. Treasury bills, notes, and bonds, or the equivalent government bonds issued by the government of Trinidad and Tobago, are perhaps the most significant instruments for the central bank's open market operations.
Open market operations. That's the buying and selling of bonds.
Right. This is how central banks typically control the money supply, by buying those bonds to inject money into the system and selling them to withdraw money.
So they're essentially turning government debt into liquid cash for the banking system, or vice versa, influencing the economy's overall liquidity and interest rates.
Precisely. Through programs similar to the borrower in custody program we discussed earlier, central banks can accept commercial loans held by banks as collateral, even if those loans are held on-site at the member banks.
Again, for efficiency.
Right. And finally, bankers' acceptances, which are time drafts accepted by a bank, often used in trade finance. These are crucial and often eligible for rediscount or purchase by the central bank, further supporting international trade flows.
Okay.
So it's abundantly clear that each of these institutions, commercial banks, courts, and central banks, serves a distinct and vital function in recognizing and validating these instruments.
It really reinforces the point, doesn't it? That it's this comprehensive, interconnected network that gives them their true power and allows them to function as the bedrock of our financial system. It's not just one thing.
It does. Each instrument gains its full monetary and legal power only when it's firmly embedded within this recognized statutory and institutional framework. That framework is what binds the parties to performance and enables the conversion of these promises into actual currency or legal judgments.
It's a complex, interconnected web, and understanding that web is truly key to understanding modern finance and how value is created and moved around. You need all the pieces working together. Now, let's pivot our deep dive. We've journeyed through the abstract world of financial instruments, seeing how mere promises can become potent creators of money and liquidity. But let's bring these powerful concepts directly to your daily experience, to something profoundly personal to each of you at Royal Bank, your pension fund.
Right, connecting it back.
This is where all those foundational concepts about financial instruments truly come together in a very personal way. How does a company like Royal Bank use employee information, your information, to facilitate a pension fund? And how does this process go far beyond just saving for retirement to become a sophisticated financial instrument in its own right?
An instrument for the bank.
An instrument that can generate significant value for the bank itself. Because let's be clear, it absolutely does.
Yeah, this is the core question for many listeners today, I imagine. We're talking about your pension trust or a retirement fund. Specifically, in this context, it's often structured as a defined benefit pension plan, and that plan itself acts as a powerful legal instrument.
That's an excellent point, because many people think of their pension as just contributions going into a pot, maybe growing a bit, and then payouts coming out later. Simple savings. But you're saying it's much more sophisticated than that simple picture. How does that initial legal structure really work?
Well, when Royal Bank establishes a pension fund, the initial structure involves a crucial legal formation. A trust is created. This trust is a legal entity. It's distinct and separate from the employer, from Royal Bank itself.
Okay, so it's its own legal thing, like a separate company almost, established just for the pension.
Yeah.
Why is that separation so important? Why not just keep it in the bank's main accounts?
That separation is critical for legal and fiduciary reasons. It protects the pension assets. Royal Bank in this scenario typically acts as either the plan sponsor, that's the employer responsible for setting up and funding the plan, and/or the trustee.
The trustee, the manager.
The trustee is the fiduciary custodian legally responsible for managing the pension fund's assets in the best interest of the beneficiaries.
And the beneficiaries are?
You, the employees. The bank has a legal duty, a fiduciary duty, to manage that money for your benefit.
Okay.
So the pension fund isn't just a pot of money sitting in the bank's general accounts. It's a legally defined and separate entity with its own obligations governed by trust law. This separation is key for protecting the assets and ensuring the bank acts as a responsible steward of those funds.
Precisely. And this is where your personal employee information becomes absolutely critical to this structure.
Right.
Data points like your name, your national identification number, your date of birth, your comprehensive salary history, your tenure with the bank, even your beneficiary designations. All of this is meticulously collected and utilized.
Why is this data so critical? I mean, obviously they need it for record keeping, sending you statements and eventually paying benefits.
Right, but what's it really used for beyond that? Beyond just knowing who you are and where to send your benefits in the future?
It's used to calculate what are known as projected benefit obligations, or PBOs.
PBOs, okay, what are those?
These PBOs are essentially the future legally enforceable claims that you, the employees, have against the pension fund.
Claims like legal IOUs from the fund to us, saying they owe us money in the future when we retire. So your personal details directly inform a liability on the bank's books.
In a sense, yes. They represent the estimated total amount of money the bank, through the pension trust, will need to pay out to all its employees in retirement.
And how do they estimate that?
It's based on current salaries, projected salary increases over your career, years of service, life expectancy estimates, inflation assumptions, a whole range of actuarial factors. It's a really sophisticated forecast of the bank's future payment responsibilities to its employees.
So it translates directly into a very tangible liability for Royal Bank. The more employees, the higher the salaries, the longer the tenure, the larger these future liabilities become.
Exactly. And these future liabilities, what the bank legally owes to its employees in retirement, are recorded actuarially. This is a complex accounting and statistical process. It's not just a guess.
And it's required by law.
Oh, yes. It's mandated by foundational laws, similar to the Employee Retirement Income Security Act, or ERISA in the U.S., or equivalent legislation right here in Trinidad and Tobago, which sets minimum standards for most voluntarily established pension plans.
So there are strict rules about how they have to calculate and account for this. It's not just an internal estimate. It's a legally required calculation that binds them.
Oh, absolutely. These legal requirements ensure that the pension liabilities are properly accounted for and, crucially, adequately funded over time. They become formal trust obligations, binding the bank to its promises to you. This is why your pension isn't just a casual benefit. It's a deeply entrenched legal and financial commitment from the bank.
Okay, this is where we get to the core of why this deep dive is so important for you, the Royal Bank staff. You want to understand not just how your pension works for you, but how the bank itself profits from establishing and managing these pension funds.
Right. The other side of the coin.
Because it's not just about collecting contributions and paying out benefits. There are incredibly sophisticated financial mechanisms at play that generate significant revenue and value for the bank. Let's pull back that curtain now and reveal the profit funnel.
Let's break down these stages of monetization, because this is where the real complexity and value generation happens for the institution. Starting with the most visible one. What's the most obvious way the bank profits from managing the pension?
Well, the first and perhaps most obvious profit stream for the bank is through asset management fees. As the fiduciary or investment manager of the pension fund, Royal Bank charges fees.
Fees for managing the money.
Exactly. These fees are typically based on the total assets under management, or AUM, of the pension fund. Think of it this way. For every dollar in the pension fund, a small percentage, maybe 0.5%, maybe more, annually, is charged as a fee for managing that money.
And these funds are massive, aren't they? For a bank like Royal Bank, we're not talking small change here. We're likely talking about billions of dollars in pension assets. What kind of revenue does that actually generate for the bank?
It's significant. Pension funds for large institutions like Royal Bank can be enormous, stretching into billions of dollars potentially. So even a small percentage fee generates substantial revenue. These fees represent a direct, visible, and consistent revenue stream for the bank.
And what do those fees cover?
Well, they cover their administrative costs, the investment management expertise, compliance efforts, reporting, and yes, they usually include a profit margin for the bank providing the service. It's a fundamental part of the asset management business model. Just like a mutual fund charges a fee for managing your investment.
That one seems pretty straightforward. It's a fee for service, essentially. Manage the money, get paid a percentage. But then it gets much more sophisticated, right? How else does the bank make money from this, beyond just the direct fees?
Indeed. The second mechanism is what's known as the investment spread, or yield arbitrage. This is where the bank gets particularly clever, financially speaking.
Arbitrage? Sounds complex.
It can be. Royal Bank takes the pension contributions and strategically invests them across a diverse range of financial instruments. This could include stable government bonds, corporate debt, real estate, equities, maybe even alternative investments like private equity or hedge funds.
Okay, diversifying to manage risk and seek returns, right? That's standard investment practice. But where's the clever play you mentioned, the arbitrage? How does that generate profit specifically from the pension fund for the bank?
The clever play here is how they capture the spread, or the yield differential, between two key figures. First, there's the actual returns they earn on these investments. Let's say, for example, they achieve an average of 7% annually over the long term.
Okay, 7% return on the assets.
Second, there are the typically lower discounted liability assumptions they use for pension payouts. These are based on those actuarial projections and prevailing interest rates we talked about. Maybe they assume the liabilities, what they owe you in the future, will grow at, say, 4% per year based on their calculations.
Ah, I see. So they're aiming to earn more on the investments, the 7%, than the rate at which their calculated obligation to employees is growing, the 4%. That difference, that 3%, is where the profit comes in for the institution.
Exactly. If the fund performs well and becomes overfunded, meaning the assets grow faster than the calculated future liabilities, this yield differential, that 3% difference in our example, creates significant institutional profit for the bank.
How does that profit show up on the bank's financial statements? For someone not directly in accounting, how would they see its impact? Is it just extra cash?
It's usually more subtle than just extra cash showing up. On their financial statements, it often reflects as a reduction in the net pension expense they have to report on their income statement. Or sometimes it increases what's called other comprehensive income, which basically refers to certain types of gains or losses that bypass the traditional income statement but still affect the company's overall net worth or equity.
So it makes the bank look healthier financially.
Exactly. It effectively boosts the bank's bottom line and strengthens their financial health. This strategy is a powerful way for the bank to leverage the sheer volume of assets within the pension fund, turning the long-term investment into current institutional gain.
That's a powerful way to leverage the funds. But it goes even further, doesn't it? Can the pension assets themselves, the actual bonds or stocks, be used by the bank for other purposes? That sounds concerning for the employee's security.
It's a complex area and highly regulated, but yes, the third mechanism involves the use of pension assets as collateral. Not spending them, but using their value.
Collateral for what?
Pension fund assets, particularly the high-grade liquid securities, like government bonds issued by Trinidad and Tobago or the U.S., can be pledged by the bank, acting as trustee or manager, to secure other funding for the bank's broader operations.
Okay, for what purpose? What kind of funding are we talking about? And how does the bank ensure that leveraging these assets for its own liquidity doesn't, even inadvertently, put the pension fund itself at greater risk or somehow reduce the long-term benefit for the employees? That seems like a conflict of interest.
Great questions. They can use these assets as collateral to secure other funding for the bank's broader operations. For instance, they might use them in repurchase agreements or repos where they borrow cash overnight or short-term against these securities. Or they might use them to underpin derivative transactions or simply to provide interbank liquidity for their own balance sheet needs, perhaps meeting regulatory requirements.
So using the pension assets to get cheaper loans for the bank itself.
Essentially, yes, or to support other profitable activities. And to your excellent point about risk and conflict of interest, strict legal and fiduciary limits are in place. This is heavily regulated. The assets still legally belong to the trust for the beneficiaries. They're still your pension.
They can't sell them off?
No. But their value can be leveraged without transferring ownership. And this links directly to the central bank again.
How so? The central bank gets involved here too.
Crucially, under central bank operating circulars and regulations, like the Federal Reserve's Operating Circular 10 in the U.S., or similar frameworks locally, these high-quality assets held by the pension fund, which the bank manages, can often be pledged at the discount window.
Ah, the discount window again. So the bank can borrow from the central bank using the pensions bonds as security.
Yes. This gives Royal Bank potentially low-cost, short-term access to cash from the central bank. Or it allows them to leverage these assets for other bank lending or broader market activities, like funding new loans to commercial clients or expanding their trading operations.
So it's a sophisticated way for the bank to generate additional liquidity and capital, essentially using the underlying value of the pension fund assets as leverage for its wider institutional purposes. And as you mentioned, this is all subject to extensive regulation to protect the pension beneficiaries.
Right. So the money set aside for our pensions isn't just sitting there passively. It's actively helping the bank generate liquidity and potentially profit for other parts of its business. That's a significant revelation for many, I'd imagine. What about creating entirely new instruments from these pension obligations? That sounds incredibly complex, even more so.
That's the fourth mechanism, and it is quite advanced. Securitization of pension cash flows. This involves transforming future pension fund receivables, like the projected streams of annuity payments that will be made to retirees over decades, into tradable financial products.
So it's like taking all those future pension payments, bundling them up, and turning them into a bond today that can be bought and sold. That's a fantastic analogy for how it operates, like mortgage-backed securities, but backed by pension promises.
It's a very similar concept. These are often structured into what are known as asset-backed securities, or ABS. These ABS instruments, backed by the expected future pension payments, are then sold to investors in the broader capital markets.
Why would they do that?
This process creates immediate liquidity for the entity doing the securitizing. Sometimes the plan sponsor, the bank itself perhaps, if it's addressing funding issues, though this is very complex and less common for corporate plans directly, or potentially government entities related to public pension funding. It converts long-term illiquid obligations into immediate capital.
And generates fees.
Yes, and it can generate additional servicing income for the institution that structured the deal.
Can you give us a concrete example of how a bank might profit here, even if it's not securitizing its own internal pension directly? Because that sounds risky.
Certainly. While less common for corporate plans directly, sometimes government entities issue pension obligation bonds, or POBs. They issue bonds today, use the proceeds to shore up a pension fund, and promise to repay the bondholders over time.
Replacing an unfunded pension liability with bond debt.
Exactly. If a bank like Royal Bank were involved in structuring, underwriting, or distributing such bonds, perhaps for a state entity, or even theoretically structuring something based on its own plan's assets and liabilities, which would be extremely intricate and regulated, it would earn significant fees.
Underwriting fees, structuring fees for putting the deal together, maybe advisory fees.
Exactly. Plus potentially ongoing servicing fees if they manage the underlying cash flows. They might even hold on to certain tranches of these deals, profiting from their performance. It's a way to accelerate the recognition of future value or manage liabilities using capital markets expertise. This is truly transforming future promises into immediate tradable assets or liabilities recognized today.
And finally, there's another way the bank can profit, this time by managing or even shedding its own liabilities related to the pension, getting rid of the obligation.
Indeed, the fifth mechanism is discounting pension liabilities. This often occurs when the bank, as the plan sponsor, wants to de-risk its pension obligations. A common way is by transferring these future liabilities to an external entity, typically a large insurance company.
A pension buyout, I've heard of those. So the bank pays the insurance company to take over its pension responsibilities completely.
Right. The bank pays a large lump sum premium today. The insurer takes over the legal responsibility for making all future payments to the retirees.
How does the bank profit from this? They're paying out a huge sum of money, maybe billions. So where's the actual gain for Royal Bank in doing that?
They profit if the lump sum premium they pay the insurer is less than the value of the pension liability recorded on their own balance sheet.
How can that happen? Why would the insurer charge less than the liability?
This difference arises from variations in actuarial assumptions. Things like life expectancy projection. Maybe the insurer uses different, perhaps more optimistic mortality tables. And crucially, the discount rate used to calculate the present value of those future payments might differ. The insurer might be able to manage the assets more efficiently or use a different discount rate.
So if the insurer uses different assumptions or simply offers a competitive price to take on that future obligation because they're specialists, the bank could actually book a gain on the transaction, even though they're paying out a large sum.
Exactly. Imagine Royal Bank has a calculated future pension liability valued at $100 million on its books. If an insurer agrees to take it over for a $95 million premium, the bank effectively books a $5 million gain on that obligation transfer.
And what are the benefits for the bank besides that immediate gain?
It helps them clean up their balance sheet, removes that long-term risk associated with future pension payouts and investment performance volatility, and can free up capital that was previously reserved against that pension liability. It's a strategic move to manage risk and optimize their financial position.
Wow. Okay. So let's quickly summarize Royal Bank's potential profit funnel from managing your pension funds. It's far, far more complex than just earning management fees.
Absolutely. We're talking about potentially 5 distinct mechanisms through which a bank managing or sponsoring a large pension fund can generate significant institutional profit or value.
Okay, number 1.
1. Asset management fees, direct income for managing the fund. 2. Investment spread or yield arbitrage, paying more on investments than the assumed liability growth rate.
Making money on the difference.
Right. 3. Collateralization, leveraging high-quality pension assets for broader bank liquidity and potentially low-cost funding from the central bank.
Using the assets as security.
4. Securitization, potentially earning fees by structuring future cash flows into tradable securities. This is more complex and context-dependent. And 5. Discounting liabilities, capturing gains through favorable transfers or de-risking of future pension obligations, often via insurance buyouts.
Each of these operates within a sophisticated legal and financial framework. It's truly transforming what might seem like a straightforward employee benefit into a powerful generator of value or a risk management tool for the institution itself.
And it's crucial to remember that all of these practices are supported by a broader legal framework. These aren't backroom deals. These are generally legally established mechanisms that financial institutions globally, including those operating under the regulations in Trinidad and Tobago, utilize.
So laws cover all this.
Yes. Comprehensive laws governing employee benefits and retirement plans, various banking regulations, trust laws specifying fiduciary duties, and fundamental components of central bank acts. These provide the authority and the parameters for how pension funds operate, how their assets are managed, and how they integrate into the broader financial system.
It's a powerful illustration of how credit, which in this case includes your future pension claims, becomes capital for the bank. And that capital, through these sophisticated financial instruments and market mechanisms, ultimately contributes to the overall currency flow and liquidity in the economy. It's almost like a hidden engine contributing to the entire financial system.
This is how the financial world leverages future promises into present-day financial power and manages long-term risks. It's the essence of modern finance, really.
So there you have it. We've truly tried to pull back the curtain today. We've looked at how financial instruments are foundational to money creation, how a pension fund, specifically yours at Royal Bank, operates as an incredibly sophisticated financial instrument, and the multiple, often nuanced ways a bank can potentially profit or derive value from managing it.
It's a lot to take in.
It is. Our hope is that by understanding these complex processes, you, the staff member, gain a deeper appreciation of the vast financial ecosystem your pension operates within. It perhaps sheds light on how your contributions, along with your valuable personal data, which helps calculate those PBOs, those future obligations, are not just sitting passively in a silo waiting for retirement.
Yeah, they're active.
But are an active, dynamic part of this much broader financial system, contributing to the bank's balance sheet, its liquidity, and its potential profitability in ways you might never have imagined before.
And here's a final thought for you to mull over, building on that powerful idea that money is not metal, it is trust inscribed. We've seen how credit, your future claims, can become capital for institutions, and how that capital can become currency and liquidity in the wider economy.
Yeah.
Now, armed with this deeper understanding, consider the profound implications of this intricate system. Think about it in terms of your own financial planning, maybe, and perhaps the future of institutional finance itself. Next time you look at your pension statement from Royal Bank,
You'll see it differently.
perhaps you'll see it with a newfound understanding. You'll recognize the deep financial mechanisms at play, the extensive regulatory environment that governs it all, and just how crucial trust in the bank, trust in the system, trust in the regulators truly is in the everyday value and security of your future claims. That trust is the invisible foundation.
Definitely some food for thought there. A whole new perspective on the pension statement.
Absolutely. Thanks for joining us on this deep dive.